today. How can we create this successful financial plan? The learning objective of this chapter is to describe, and at the end of the presentation and chapter, we expect you to reach how to prepare the basic financial statements and how can you use them for the small businesses, and creating a project, especially the pro forma project for the financial statements. And end of the chapter, we expect you to understand the basic financial statements through ratio analysis. So you already know most of them, as far as I remember, because you're receiving accountancy lecture, something like that, or also economics lecture. And the fourth objective is to explain how to interpret financial ratios, and the fifth one, conducting a break-even point, which is the equal point for the cost and income for the financial management. So if we have the financial resources, it means that we need to manage these resources, whether it can be or it can be our resources or resources from outside. So the management is the process that is provides entrepreneurs with the relevant financial information in an easy-to-read format on a timely basis. It can be whether monthly, yearly, or weekly, even daily. So financial management allows entrepreneurs to know not only how their businesses are doing financially, but also they are performing at the right way. So it's kind of an indicators. It's a tracking and monitoring tool. When something is wrong, we can detect promptly, and we can make the corrections and solve the problems. So who is prepared and who is looking for this financial management? So when we look at the potential lenders and investors would like to see the financial reports, so they request a realistic financial plan before investing their money to the startups or the new business formations. It is also important medium to help entrepreneurs to manage their businesses more effectively, to monitor, and also it's a road plan for the future. It shows past, current time, and the future as well. So it also helps understanding financial statements and other accounting records. That is helpful to detect the problems and solve these problems. And it gives the clues on how to increase your profits. And finally, it's also useful to reach profit objectives. Most entrepreneurs must be aware of their company's overall financial positions, and they need to show and prove it for the outside financial resources. So basic financial statements is really important. It's a projected financial statements, and it's helpful to review the financial reports, and it can be measurable, and it shows the company's financial positions for the company, for the managers of the company and customers and the possible investors. One of them is the balance sheet. It's a financial statement provides a snapshot view of the business plan. So it shows the current situation. And also it estimates its worth on a given date. And as you all know it, the fundamental accounting equations, assets equals liabilities plus owner's equity. This is really important. The balance sheet is usually prepared for the last day of the month, and it is presented and shows the current situation. And the assets and words, the current assets, such as the cash and other items to be converted into cash easily within a year or within the company's normal operation cycles. So those are the sums of the current assets. Fixed assets acquired for the long-term use in the business, and intangible assets includes items such as goodwill, copyright, and patents. Although valuable, but not tangible. So some of them can be easily converted, and some of them is not easily converted. And cash is easily converted, and items like valuable things. And on the other hand, liabilities is the company's assets. So the current liabilities can be the debts that can be paid within a year or within a normal operating cycle of the company. And the long-term liabilities come due after 1 year, and owner's equity, the value of the owner's investment in the business. So the income statements, financial statements represent a moving picture of the business, and on comparing its expenses against the revenue. So it should be in the statement, it should be equal. So when you see those kind of tables, you need to see these incomes and revenues. So the income statements, also called the profit and loss statements. The income from other sources such as rent, investments, and interest, they also must be included in the revenue section. And cost of goods can be services or the products, whatever. The total costs, including shipping and of the merchandise sold during the accounting period. Another one is the gross profit margin. It's divided by net salary revenue, and operating expenses, also the cost that contribute directly to the manufacturing and distributing of the goods. So you can see one example from the net sales revenue, the credits and cash sales, you can see, and the cost of the goods sold and operating expenses, and you can see the total operation expenses, the sum of beginning inventory and operating expenses, and general expenses such as utilities, phones, electricity, postage, and these kind of things. And also you need to consider the other expenses. So it shows the, for example, the end of the month of the situation of the company, and you can see the expenses and the income such like this. The cash flows is really important. The financial statements showing the charges in a company's working capital from the beginning of the year. And sometimes creators, lenders, investors, or business buyers may require this information. So when you ask for the capital or financial resources, they would like to see like this. Depreciations is listed as a source of funds because it is not a non-cash expense that has already been deducted as a cost of doing businesses. And you need to create a projected financial statements, which means that based on the data available, and you need to make the calculations and try to predict the sales, costs, income in the future. So it is really important for the investments and everything. And those projected statements help entrepreneurs to transfer their business goals into reality. So without the expectations, you cannot do anything. So you need to collect the real data from the market and also the competitors to make a good and reliable and valuable projections. And you need to answer the questions such as what profit can be business expected to earn, and if an enormous profit object is, for example, X dollars, what sales level must the company achieve, and what fixed and variable expenses can the owner expect at the level of sales? So those are the some questions should be answered with the proper collected data. And projected financial statements for a business, small businesses, is really one of the important tasks for the entrepreneurs to startups, especially the new enterprise, is to determine the amount of funding required to begin the operation, whether it can be their own resources or the finance from the outside. The amount of money needed to begin a business depends on the type of operation, is located inventory requirements, sales volumes, and many other factors. And every companies must have enough capital to cover all the startup costs. And after this calculation, they need to consider their resources and what kind of money they needed for the credits or other things. So they need to expect for the future. As long as they start production and selling, they cannot get the profits. So the cost so far that has been made is going to be continue after some point, and after that point, then the company will becoming getting more profits. So these startup costs can be the rent or buying the equipments, machines, tools, and also the pay for advertising licenses, and also utilities, other expenses, and also the cost for the staff and other things. So you need to rent the places, this kind of thing. So you need to stand those kind of expenses, maybe more than that, maybe other financial requirements, legal requirements, permissions, things like this. So you need to spend lots of money, for example, for the project preparation. And you need to stand for a while, even after selling your products. So, for example, in companies, we call it investment period. It can be vary from 3 to 5 years or even more. So during that time, you need to spend and invest money, and it's going to be cost, and you cannot take back this cost easily. So these projected income statements, creating a projected income statements is the first step to create a sales forecast. So as an entrepreneur has two options: to develop a sales forecast and work down, or to set up a profit target to work it up. This is really important, whether they're going to increase the sales or to decrease the working capacity. So the second step is to estimate the expenses, and the entrepreneur target income is the sum of the reasonable salary for the time spent running the business. And after this one, they need to compare the sales with the expenses, and which point they're going to equal the cost and expenses and sales. Then after some point, the sales, the amount of sales will be more than the expenses, and after some point they're going to become more profitable. Entrepreneur can contact potential vendors, suppliers, and providers to estimate these expenses. And also reinventing the extra money is the company accelerate its growth rate. So if you have more money, then you can hasten the process. But sometimes in some sectors it is not possible, especially in agriculture sector. You need to wait because you're dependent to the nature. But in the industry sector or service sector, when you increase the expenses and the inputs, then you can parallelly and directly increase the income. But in agriculture, it is not the case. So you need to wait to the harvest, things like this. And ratio analysis, there are several ratio analysis, and it shows the relations between any two accounting elements that allows business owners to analyze their company's financial performances. And smart entrepreneurs, they make a solid business plan, and they always keep their mind and to enlarge their company for the desired position, and to reach this target, they properly makes the financial control. So the control shows us our situation and also help to identify the problems to solve it. And the critical point is that business success is really important. Otherwise, without solving the problems, we cannot get currently available in the market. So there are 12 key ratios in different sources. We are going to explain some of them. We are not expecting you to understand and solve all of them, but we expect you to be aware of these different ratios, and it can be also divided into 4 categories. One is the liquidity ratios, leverage ratios, operating ratios, and profitability ratios. And the liquidity ratios tells whether a small business will be able to meet its short-term financial obligations. This is really important. So liquidity ratios, as we all explained, the primary measures of the liquidity ratios, and that could be current and quick ratios. The current one measures a small company's solvency by indicating its ability to pay current liabilities out of the current assets. And it can be calculated into current assets divided by current liabilities. Another one is the Acute Ratio. Sometimes can be misleading because it does not reflect the quality of the company's current assets. It is a conservative measures of the company's liquidity and measuring the extent to which its most liquid assets cover its current liabilities, and it can be calculated. Quick ratio equals you can divide quick assets into current liabilities. So there are some relations like this. Another one is the current assets. Shows the companies how those companies can convert into cash immediately if needed, and excluded the most liquid assets. So this is really important. Another group, liquidity from the liquidity ratios, leverage ratios, and there are some ratios such as debt ratio, debt to net worth, and times interest earn ratio. Those financial data is really important. So it's like a gauge of the debt of the companies. So this is really important. So I'm not going to explain you one by one, but total debt, as you all know, it includes all the liabilities and any outstanding long-term notes and bonds. And total assets represent the sum of the company's current assets, fixed assets, and intangible assets. So this is really important. So the debt ratio is calculated to total debt divided by the total assets. This is the basic ratio. And the debt to the net worth ratio is calculated such as total debt divided by the tangible net worth. And another one is the operation ratios, 3 of them: average inventory turnover ratio, a collection period ratio, and average payable period ratio, and other measures. Those operating ratios help an entrepreneur evaluate a small company's overall performance and indicate how effectively the business employs its resources. And profitability ratio indicates how efficiently a small company is being managed. And those are the some indicators of the profitability ratio, such as net profit on sales ratio, net profit to asset ratio, and net profit to equity ratio. Those are some of the measures. And the interpreting business ratio is really important. Especially ratios are usually a criteria when measuring a small company's performance, and can point out potential problems before they develop into serious crisis. So these are maybe the last stop before the motorway, or you need to be really careful. You need to solve the small problems, otherwise small problems can be converted into a big serious crisis. So the companies and the entrepreneurs must know and understand which ratios are more crucial to their company success, and focus on monitoring and controlling those indicators. So evaluating is really important at the end of the year. But when you realize that everything has already been neglected and it's already very late, so that's why tracking the spots promptly and monitoring the systems and correcting, controlling, and converting this system is really important. So the precaution is much more easier and low cost than solving the problems or healing, something like that. So precautions is always the case and most simple and very easy to detect. Otherwise, the problems will be tremendous. Financial benchmarking is a process in which an entrepreneur compares a company's key financial indicators to average from many companies of a small size in the same industry in order to identify the problems areas at the company's own history. So this is really important. You need to compare the process and the different ratios. And finally, we are going to talk about the break-even analysis, or it is sometimes called break-even point. It's really important. The level of an operation at which a company neither earns a profit nor incurs a loss. So it's a balance. It's an equation. And at this level, an activity sales equals expenses. So the revenue equals expenses. After that point, then company becoming more profitable. So that's why it is called break-even point. Most potential lenders and investors would like to see and expect entrepreneurs to prepare a break-even analysis to assess their performance, and this also helps them to evaluate the earning potential of the new business company. So sooner the better. When you reach this break-even point sooner, it means that you're going to become more profitable in the short term. So the longer period means that you're going to spend more money. Calculating the break-even point is like this, and to begin the analysis, entrepreneurs must determine the fixed and the variable costs. And as you all know, the fixed costs they don't change in terms of volume of sales or production. On the other hand, variable expenses varies based on the sales and production. But we all know it. In the long run, all the expenses will turn into a variable one. This is the case. Anyway, some expenses can be neatly categorized as fixed or variable because they contain elements of both. So they're difficult to differentiate because it can be converted into different ones. For example, the fixed cost can be converted into variable cost, or sometimes it is very difficult to classify. Can be semi-variable expenses exist. Anyway, after this explanation, we need to consider the fixed and the variable cost. And in order to calculate the break-even sales, we need to divide total fixed cost into contribution margin expressed as a percentage of sales. So the magic show will earn no profit and will occur no loss. So this is an equation point, actually. What is adding a profit? For example, a magic shop's owner wants to do a better than just break-even point. And this should be a goal of all entrepreneurs, just as a track of coach tell runners to run through the finish line, and football coaches want their players to run over the goal into the end zone. It's things like this. And similarly, an entrepreneur should never be satisfied with simply reaching even points. They would like to, increase and pass this point to score it or to make it more profit. So what level of the sales must be the magic shop achieving to generate this break-even? The entrepreneur can calculate this by treating the desired profit as if it were a fixed cost, modifying the break-even formula, and the sales equals total fixed expenses plus desired net income, and divided by contribution marginal expense as a percentage of sales. So we're going to see with the graphs, before we move on to the graphs, so we need to explain with the units. Some small businesses prefer to express the break-even points in units of products or sales, and the manufacturers often find this approach particularly useful. The following formula computes the break-even points in units, such as break-even volume equals total fixed cost divided into total price per unit, subtracted from the variable cost per unit. Another one is break-even volume units. Total fixed cost is divided into per unit contributions margins, and the contribution margins equals variable cost per unit deducted from the price per unit. So after this formula, you're going to understand with that one. As you can see on the graph, we should remember the total expenses, which is the fixed expenses and variable expenses. And as you can see, the income and expenses on the axis, and also the sales volume. So when the sales volume increases, in the beginning, your expenses will increase. So in the beginning, your expenses is higher than your sales. So after some point, you started production your products and started selling. But when you start selling, you cannot get the profit. So you need to increase your sales, and after the some point, the total sales, when they reach to some point, then you're becoming more profitable. So in the beginning, the revenues will be higher than your sales, and after some point, it will be vice versa. So you can see this one is the fixed expenses, because you need to have a time to produce your products or services, and you cannot, as long as you open or your business, you cannot directly becoming more profitable. So you need to wait for the investment period. So as you can see, those are the expenses. You need to start with the fixed expenses, and then your expenses will increase during the beginning of the company, before starting your enterprise, before opening your shops, whatever. Then it will increase by the sales and volume. When the sales and volume increases, and after some point, the revenues will increase. So it means that when the revenues equals the expenses, we call this point the break-even point. It's the equilibrium for the sales and expenses. After that point, you're becoming more profitable, because your expenses will decrease and your sales will increase. So it means that this area is the loss area, and this triangular area is the profit area. And after this point, you're becoming profitable. So finally, to summarize this chapter, using break-even analysis provides an opportunity for integrated analysis of sales, volume, expenses, income, and other relevant factors such as fixed costs and everything. An entrepreneur can determine the effects of various financial strategies on the business operations, and break-even analysis does not certain limitations. It ignores the importance of the cash flows. So you need to consider the cash flows at the same time. So it's just one-dimensional, two-dimensional things. And there are several factors which affect the financial performance of a company. So you should be really careful, because when we analyze this graph with the two dimension, we include those two variables and exclude other factors. And in reality, in the real life, everything is much more complex, and there are several factors affect these financial performances. So the accuracy of the analysis depends on the accuracy of the revenue and expenses estimates, but we should always keep our mind that several factors can be easily affect this situation. So thank you very much for your attention.